Welcome to Talk Tickers, everyone. Today, we are digging into Wendy's latest Q3 earnings, and this one was a real head-scratcher. We saw a massive stock pop on what looked like a huge earnings beat, but then it just fizzled. So what on earth did the market see that caused such a dramatic reversal? Let's break down the story behind those numbers. Okay, let's just dive right into this, because it really tells the story. You can see the stock just shot up. I mean, a full 12% in pre-market trading as soon as the results hit the wire. But then look at the closing bell. That huge gain had just withered away to only 1.6%. This really sets up our big question. What did investors hear on that conference call that completely cooled their initial excitement? So first, let's talk about what got everyone so excited in the first place. The headline numbers were, without a doubt, a surprise beat. In what's been a really tough environment for consumers, Wendy's managed to post results that were way better than what Wall Street was bracing for. And here are the specifics. Adjusted earnings per share came in at 24 cents, totally crushing the 20-cent consensus. That's a 20% beat. And revenue did too, coming in at almost $550 million when everyone was expecting something closer to $535 million. I mean, on paper, this looks like an absolute, unambiguous win. And it wasn't just about what they did, but what they said they were going to do. Management also signaled a ton of confidence by raising their full-year free cash flow outlook by a really healthy $35 million. More cash is always a good sign, and it just added fuel to that early morning fire. So with all this good news, why the fizzle? Well, as investors and analysts started to really dig into the details of the call, a much more complicated and honestly a more concerning picture started to emerge. And it was all centered on the health of Wendy's most important market, their core U.S. business. And wow, this slide really just lays it all out, doesn't it? This is the core tension of the entire quarter. The international business is actually doing pretty well, growing nicely with same-restaurant sales up 3%. But at home, in the U.S., the business is struggling, and struggling mightily, down a really worrying 4.7%. That international strength is basically just masking a significant weakness at home. To their credit, management didn't try to hide from the issue. The interim CEO, Ken Cook, he stated it very plainly on the call. He acknowledged that U.S. sales are under pressure and that they're acting with, quote, urgency to fix it. And that word, urgency, well, it tells you everything you need to know about how seriously they're taking this decline. So, hiding behind that really nice headline beat, the fundamentals in the U.S. were just flashing red. First off, customer traffic is down. People just aren't coming in as much. Second, the profitability is getting squeezed, hard. Restaurant margins fell 250 basis points. And third, they are in a brutal fight with competitors for consumers who are watching every penny. This is the trifecta of concerns that really gave investors pause. Okay, so with the problem clearly identified, the entire call pivoted to the solution. Management spent a good chunk of time laying out Project Fresh, which is their big, comprehensive plan to stop the bleeding and hopefully engineer a turnaround here in the U.S. Now, what's really fascinating here is the core of the strategy. It is a classic shrink-to-grow playbook. Basically, they plan to close between 200 and 350 of their absolute worst-performing U.S. restaurants. The idea, which sounds a little backward at first, is that by cutting off the dead weight, the entire system gets healthier, it gets more profitable, and the average sales per store, what we call AUVs, will actually rise. It's a painful move for sure, but probably a necessary one. So, Project Fresh is built on these 4 pillars. First, you've got brand revitalization. That's all about marketing, reminding people why they love Wendy's. Second is operational excellence, which is just about making the in-store experience better. Third is system optimization. That's the store closures we just talked about. And finally, capital allocation, which is all about reinvesting money where it's going to have the biggest bang for its buck. And they did offer a little glimmer of hope that this plan might actually work. Management made sure to point out that their company-operated restaurants, the ones where they have direct control to make these changes, they actually outperformed the franchisee system by a massive 400 basis points. And crucially, they said this was driven by better traffic. It's an early proof point that that operational excellence pillar isn't just a bunch of talk. So that brings us to our verdict. We've seen the good, we've seen the bad, and we've seen the plan to fix it all. Now, the question is, how do we put all this together as we look ahead to the next quarter and beyond? What really matters from here? So the question for any investor right now is pretty simple. What are the key signals that are going to tell us if this Project Fresh thing is actually working? What metrics should you have on your dashboard for the next earnings call?
Here's what we're watching. First and foremost, U.S. traffic. It absolutely has to stop going down and start going up. Simple as that. Second, the pace of those store closures. Are they doing it efficiently? Third, keep an eye on new products like the national launch of their chicken tenders. And finally, you have to watch for signs that those operational improvements are spreading from the company stores to the much, much larger franchise system. That 400 basis point gap has got to close.
All right, so what does this all mean for the next call? Well, first, we expect Q4 results to be pretty weak as management is focused on these long-term fixes, not short-term promotions. Because of this, we think the stock is just going to be range-bound. The market is officially in show-me mode now, waiting for real, tangible proof that the turnaround is taking hold. All of this brings us to our final rating. So our final verdict here is a market perform rating for Wendy's. That strong international business provides a really solid floor, which should prevent a total collapse. But the deep uncertainty and the significant execution risk of this huge U.S. turnaround are going to cap any major upside for the foreseeable future. It's a classic wait-and-see story. And as always, please remember this content is for informational purposes only. It is not financial advice.